very funny watching CNBC this week. I try to do that as little as possible, but sometimes I have to indulge myself in enjoying just how far base people are. You see, there's been a lot of volatility in the market lately, and I tried to talk about this yesterday, but I got caught up in the Super Tuesday stuff. But Super Tuesday connects to this. And the thing is, if you haven't been paying attention, stock market's been having these taking massive dives and then massive rallies back up, and we just have a lot of volatility up and down, like 4% moves, 3.5% moves in a single day. One day to the upside and the next day to the downside. And the media, the financial media, essentially, the way they report market moves is rooted in something called the efficient markets hypothesis. And this is an economic theory. It was supported by, I guess, mostly the Chicago school guys, although I think that the efficient markets hypothesis has a broader appeal than that. I think that there are guys within the Chicago school who deny it, and then also people outside the Chicago school who purport it. But without getting into the politics of it, as far as the economics profession is concerned, the way that the efficient markets hypothesis works is that, it says that, all prices are always based off of information and rationality, and if a price changes, that's because there's been some new information that market participants have been exposed to, and so that changes the idea of where the proper price should be, and so that's why that's how prices adjust, and particularly in reference to exchange-traded markets, which are things like the stock market. And so, according to this theory, the price moves in the stock market are based off of changes in information, news coming out. That's why, the news wire is so important. If you look at, the headlines that come across the Bloomberg terminal, those are said to be, according to this theory, what is truly moving the market up or down. And so, because of this theory, because it's assumption of truth on the part of the financial media, every day when the market moves in one direction or another, they always try and find some news story that explains this. They said, yes, the move in markets today is because of this reason. And so, for every day that this past week that there's been a down day, they've been blaming the Wu flu. And I don't think that that's entirely inaccurate. It's not that the news has, no bearing on the price of stocks, but it's very clear that, the media, whenever there is a big move in the price, they always, try and grab at something like this and say, okay, well, this is the case. Well, if the Wu flu really was what the information about the Wu flu was what brought down this market, and the sole reason why there was a big sell-off on the days that the market did sell off. Well, why would that be? Because there wasn't necessarily any new information, at least not much new information coming out about the Wu flu. We've been hearing lots of information about the Wu flu coming out. The coronavirus, by the way, for those of you who don't know the term Wu flu, it's a reference to Wuhan, the Wuhan virus. There's been news coming out about this for a month, and the markets, had very little reaction to it. In fact, we made all the new all-time highs after the whole coronavirus thing started. And so whatever, new information there happens to be on the margin, this is not a news story. It's not like all this coronavirus stuff suddenly hit all at once. So why was it that the market priced in this information all at once? If markets are efficient, the idea is that they're pricing in this information immediately. But they weren't doing that. If they were pricing it in immediately, the market would have been selling off slowly over the past few weeks as the news got worse and worse. Now, yesterday, we had, quite the opposite to the days in which, the Wu flu has been blamed for tanking the market, which today is one of those days, by the way. We had another down day, 3.5% on the S&P, I believe. Yesterday, there was not a big sell-off, and that, the media said, was because of Joe Biden's surprise Super Tuesday win. Okay, so they said that, you see, that before the market had priced in the possibility that Bernie could be the nominee, and that's bad for markets because Bernie hates rich people. He was going to eat the rich. And so that now that it looks like Bernie won't be the nominee, the markets were able to price out the downside risk from a Bernie presidency, and so that is lifting the markets yesterday. And that would make some sense, but, then you have the problem that today all those gains were pretty much wiped out. Now, is it that the coronavirus news suddenly got so much worse today than it was yesterday, that it overwhelmed, the benefit of Bernie almost being knocked out of the Democratic race? No, of course not. The news didn't suddenly get so much worse today. The news has continually been getting worse for weeks, and the market did not react to it. And so the conclusion that one should draw from all of this is not that the market is responding directly to the news and that it's just some computer that inputs news and outputs prices. The market is not that simple. It's not just people who because the thing is that the market is not this self-contained unit. It's a group of individuals, people making choices, and those people make choices for more complex reasons than just the news day by day. There's other things at play here, like group psychology and in herding, herding, the term that people get shunted into one direction, and that if everyone's running one way, well then a lot of people are just going to follow because that's their personality. There are psychological concerns here. There is just pure perceptions. There is the fact that, as I said, human beings are not computers. They make subjective choices. And the fact of the matter is that there are much more complicated things at play here. And so it's weeks like this when the technical analysts on Wall Street really come into their own, and to where they become very worthwhile people of following. Because for those of you who don't know, technical analysis seems like mumbo jumbo if you look at it, because what they do is they look at the charts, meaning the line graphs of the price of certain assets, and they look at it and they divine from it certain qualities, and they say, oh, well, look at this pattern here. This pattern means that the price is going to go up, or this pattern means the price is probably going to go down. And it's very easy to point at that and say that's nonsense. You're just drawing lines on a piece of paper, because what they do is they take these trend lines and they go boom, boom, and they go, well, eventually it's going to cross this line, and then there's going to be a big jump in the price, or there's going to be a big crash in the price. But you have to look deeper than that. In reality, what they're looking at is they're not just looking at lines on a graph. What they're looking at is the direction of sentiment, because what prices are is really an indication of sentiment. If people are buying, then they're optimistic. If people are selling, then they're pessimistic. And depending on the way in which the price moves, you get an indication of the social behavior, what's going on, the sort of social psychology of the market. And so it makes sense that these patterns aren't just lines on a graph. They're demonstrating behavior. It is in many ways largely emotional. That's how prices move from day to day in the market. These concepts such as support and resistance in a price, meaning a particular price in which, if let's say the price is on the way down like it is here and the market is crashing, all of a sudden at a certain price, you'll see that it'll start to stabilize a little bit and people start buying again. And that's because psychologically people understand that at that particular level, hey, this seems like a decent price, like an appropriate price for this asset. So maybe I'm going to buy it because maybe it'll stabilize here. This seems like an important level. And this is purely subjective. It's all psychological. And so we're seeing right now with the S&P 5,000 or 500, the 3,000 point level. That's being very important right now. Every time that we, because we broke down below 3,000 briefly, but so far the couple times that we've done it, they had shot back above 3,000, and then we saw a bit of an uptick above 3,000, and that didn't sustain, and now we're back down below almost to 3,000 again. And today closed back at 3,023. Now, why did we close at 3,023? Is it because of just a culmination of news stories and things? Is it because the coronavirus just seemed somewhat worse today, but not bad enough to where the price was below 3,000? No. It's not that it has nothing to do with that, but it's that there are certain points in the price that just stick in people's minds. Market prices are not scientific; they're very human. They're very it's an art. It's not a science trying to determine the way that these markets are going to move. And so while you can get a feel, it is absolutely just preposterous in my mind to try and walk out on stage or go onto your TV show and say, okay, here's exactly why the market moved in such a direction and to such a degree, and why the price is exactly relative to the impact of X news story or Y news story. when in reality markets are just going to move how they're going to move, because that's the way people feel in that given day, because that's just how many people showed up to buy and how many people showed up to sell. So the moral of the story is that in times like this that can be quite trying for people, when folks don't really understand why there's all this volatility in the market, just understand that it is reflective of the feelings of the folks who are actors in that market. So if you gained anything of value out of this video, I'd appreciate you clicking that like button and sharing this video. And if you haven't already, please do subscribe, because I do upload every day and I'd hate to have you miss one. So I'll see you folks back here tomorrow.